Buy the dip or dead cat bounce? Top of mind question for traders around the world, in line with our FSC vlog with your host, Ron William, on behalf of the Foundation for the Study of Cycles. We'll be focusing on that question throughout this session, buy the dip or dead cat bounce, featuring work that's been shared with industry, including clients and media, latest insights, and a recap on that behavioral inflection point and the whole lesson about the sudden dramatic change, what it means from a behavioral but also market perspective. Mind the consensus gap. Of course, that'll likely be a bigger issue as and when markets continue to surprise, particularly to the downside. The election strategy book, which continues to unwind in this very important year of the US election. And then we'll fast track onto the more actionable market and cycle work, looking at snapshot market review, and then in the grand finale, a revisit and update of the S&P 500 triple whammy risks, which has been a recurring theme throughout this market regime. So let's take a step back, zoom out, and take a picture or a cartoon that speaks many words. As the latest post-shakeout counter rally extends sharply, a top-of-mind question for investors will be buy the dip or dead cat bounce. The cartoon, which I've shared in different variations over time, continues to serve as a useful behavioral pulse check while also helping us to think laterally outside the box, especially during these precarious times. Reflect on the backpack climber verging on the cliff edge for his life and being told to buy the dip. Now, in all fairness, this is prudent investment guidance during a strong uptrend, but at the same time, nothing lasts forever, and the same good advice is often detrimental at cycle inflection points, one of the key virtues in studying cycles and being part of the community here at the FSC. There are key insights previously shared, as just mentioned, with clients, media, and also as part of this FSC vlog. A summarized report is available on Substack if you'd like to follow ronwilliam.substack.com. Now let's dive in. Sudden dramatic change. This is words of wisdom reshared from a previous session, originally from one of my mentors, Mr. David Fuller. And he made the point that sudden dramatic change is never anticipated by conventional wisdom. I've dubbed this whole idea of sudden change as a behavioral inflection point, warned in our FSC New Year event and also past sessions. But essentially, the point here from a behavioral and market perspective is that speed kills, or at the very least, it implies follow through. 2025 March correction is basically the fastest since COVID 2020, and the 7th fastest since the 1929 Wall Street peak, and the series of crashes that followed. In money terms, it's 5.5 trillion of value erased in just those few weeks. Now, I do want to speak a little bit later on about the outflow into equities in Europe, China, but actually more so in safe haven assets like treasuries and cash. But I'll car park that for now and use this base case historical analog of the volatility regime of 2022, which is how oversold the market is right now, and also an interesting case example for us to use as part of this 3-stage rollover pattern. What does all of this mean? The current short-term rally is tradable, but not likely sustainable. Overall, the bull market asymmetric risk still weighs, most notably as the long-term 200-day trends remain in make or break zones. I'll allude to this again. Watch S&P 500 right here and now at 57.50. But I do want to quickly just spotlight this analog and why it's important. This is looking at deviations from the medium-term 50-day average. You can see the current one is as bad as 2020 COVID, but as oversold as 2022. And back then, instead of having a V-shaped recovery that led to a new bull market, we had a 3-stage rollover. That's the key insight from our opening chart and market cycle analog. The follow-up is mind the consensus gap, and this is something I've shared some time ago as a prelude of what was likely going to happen and just has. Ultimately, heightened mean reversion risk in 2025 became more obvious after a post-2-year stock market bull rally amplified by record investor exuberance. Meanwhile, Wall Street consensus, which typically forecasts market to forecast, i.e. they extrapolate the linear trend, predicted the S&P 500 to rise another 10% or so versus only one outlier tail risk for a 30% drop. You can see there's the 30% drop tail risk, and the consensus is skewed to the right, i.e. happy days further ahead versus one outlier. I share the view of the outlier. These are official figures in terms of investment banks and independent research firms. But just to make the point, the many are voting bullish case scenario versus the very few that remain bearish in terms of investment bank research teams. Post S&P 500 March sell-off, the market will need to rally 20% for consensus target of 66.14. I'm alluding to this chart here, figure 4, where you see the orange line of basically consensus forecast creating a divergent gap. Wall Street strategists have suddenly now become very optimistic. Forecasts will be updated later in March, and my point here is mind the consensus gap. This is when, yes, it's good to be following experts in their field, but more so those who can adapt to fast-changing market environments, and they have cycles at the center of their framework. Now, just to make the point, the asymmetric risk in figure 2 shows how skewed it is to the right side. 2020, after COVID, was a peak out in outperformance equity markets. 2024 was second best. 2019 in and around the center line, but the big outliers were 2022 and 2008. And this is where the asymmetric risk for equity market returns is likely, for a base case scenario, similar to 2022, i.e. a 20% drawdown. We've seen close to that on the index and exactly that on certain sectors like the FANG tech stocks, or worst case, 2008, where we had a big bear drawdown of 40%. Now you can see at these key inflection points, this is where consensus gets it wrong in a big way. 2022, 2008, and of course the Y2K. More than likely, we will see 2025, 2026 also on this chart in due course. And just to close on the opening themes for this FSC vlog session, an update on the election strategy playbook. Remember, this has been a recurring theme hosted here as part of my work on behalf of the FSC. This whole idea of a 2-stage pattern: buy the rumor, fade the fact. What was the rumor? The election result itself, which was predicted as expected, a Trump 2.0 win, but the pro-economy policy that was the market was pricing in ultimately underwent an unwind thus far. Why? 2 reasons. 1, profit taking from overbought irrational exuberance extremes. That's partly because of the market run up year on year, but also the election fever. And 2, what is traditionally known as a 100-day policy stress test, and this year being the biggest stress test of them all. You can see the 2-stage pattern here in figure 2, up and then down by the rumor, fade the fact. But you can also see what followed. You had a big deviation to the downside in terms of the black line here and now. But look at the forward guidance ahead. You can see that there are 2 different scenarios. One for an incumbent 2 for a first termer. This chart is originally developed by Tom McLennan from McLennan Financial Publications. Look in their last newsletter. I've readapted it in line with the election strategy playbook. And what it basically shows is different types of impacts from different types of leaders. Now, in the case of Trump 2.0, he serves as a hybrid of the two. So a blend of the red and the green line, red being more positive, green being more negative. What's the behavioral implications? Confidence. Typically, with an incumbent leadership, there's more confidence because they have more past experience, track record, and they've built up policy levers that they can use later on, typically in a reasonable scenario. But of course, sentiment has since been exasperated in this first 100-day policy impact because of economic growth concerns, tariff risks, and what is referred to now as rapid-fire policy announcements, which ultimately creates uncertainty and volatility. So just keep in mind this roadmap, tale of two stories. Trump 2.0 serves as a blend of the two, but actually it also depends on where sentiment is right here and now. And so far, it is proving exasperated. Yes, we will get a bounce back, but the performance will likely be between the two lines you see here, or they will change according to how things develop. What does the global macro rotation suggest in terms of trends over time using cycle filters? This global ranking model, which I use as day-to-day work, is the radar screen that is used on a regular basis to look at trends. And let me be clear on what those trends are: long-term, medium-term, short-term, annual, quarterly, and monthly, to be more specific, over time. Now, this is being ranked from weakest at the bottom to strongest at the top, and top is basically strong uptrends, weakest is not. And what's interesting is not just when you get a confluence up or down, but more specifically when you get a rotation of these trends over time. Now, what it shows is clearly the Trump 2.0 risk trades shakeout. So Bitcoin clearly unwound from overbought conditions, sub 100 to 108 mark. USA exceptionalism, which is the big kind of buzz theme here and now, potentially unwinding, at least relative to the world. This doesn't have to be a big change to the US in economic and political terms, but at least relatively speaking, there is an equity market opportunity cost and even cross-asset market decision that is being made in terms of investment decisions, and that we can see plainly on our trading screens. That includes US dollar Q1 top near key supporter at 100, and that'll be a big make or break level I can speak to in future sessions. And then lastly, what is probably more important is in terms of the pending macro risks, inflation proxy is still elevated. US 10-year yields, although they're somewhat down, they're mostly volatile. Break-even spreads elevated, so inflation expectations are still higher for longer. Commodities like copper, top, you can see there in the copper red color. Gold clearly still trending strong, hitting that 3K glass ceiling predicted in past analysis that I've shared, but due a potential unwind. Now, I've received some questions about other things that are on this chart. Look at, for example, the world, which is underperforming. Remember that the USA is worth 1/3 of the market cap of the world, so it's a little bit of a US world drag effect. Then another question I got about, what about oil? Oil is, yes, in recovery mode and likely to surprise on the upside, but it has already unwound from a false bull signal. So we still have to filter out that volatility and wait for the more clear risk-reward upside setup. And then lastly, for those of you looking at crypto, Ethereum is right here at the bottom. Why? Two reasons. One, Ethereum is actually underperforming in a big way, both crypto and cross-asset, but also two, because I've put crypto in here and it has a different volatility signature, that tends to skew the results. But do remember that Ethereum is a negative outlier in general, and that's why it's at the bottom of this ranking chart. Any other questions, let me know post-session, online, or through email. Now, I've updated with new enhanced tactical tools based on the Foundation for the Study of Cycles Nowcast Market Pulse, only available for Master Working Group premium members. And you can see here, this is a screenshot of multi-time frame cycles on the futures market, looking at 4-hourly, daily, and weekly. And what it does is scan for the top outlier signals. It also tests them to see which one is dominant. And the result is S&P 500 short-term day signal, looking at equity futures, bull signal, which is now unwound from oversold conditions, but and predicting a kind of a short-term reaction here and now, but there is likely a peak into Q2, both in April and June, July. So do be aware of those inflection points ahead. And then second to that, gold, long-term weak. Yes, it's a strong trend, hitting this glass ceiling at 3,000, but there are some momentum divergences, and the cycle is pointing down eventually, if and when we get market follow through and a reversal. So there's some quick trade ideas for you to note down within your existing frameworks, and of course apply your risk and money management to make sure that it is prudent for your own work. Now, to close, I want to give you an update on the triple whammy headwind for equity markets in general, but also for this risk on, risk off theme that we've been in for some time. Remember, the triple whammy headwind is based on 1, momentum exhaustion, 2, rotation fragility, and 3, bearish cycle confluence. So I'll quickly do a fire round through all 3. Momentum exhaustion, we're looking at trend pattern reversal, topping sequence, which is a new addition I've included, and bull trap 2008 Rhine. Looking at the trend pattern reversal, we can see an update of the impulsive trend reversal still in play, but now as part of that wave 5 potential peak in corrective wave mode. The short-term time factors away. I've highlighted natural cycles in terms of macro systems impacting mood and markets. For those of you who are interested for more detail, look at the solar lunar eclipses, one that has passed and the other that is ahead in a few days, which is also being accentuated by cycle retrograde confluence. Look at the lower window here with these time factor blocks, just showing how it's created a little bit of turbulence during the cycle top highlighted in this red box. Long-term trend make or break zone, watch S&P 500 at 57.55 on the 200-day average, and related proxies too in terms of the main equity markets. Second wave retraces highly variable with different patterns and combinations. So take care when you're looking for some of those pattern recognition signals, because the market can be precarious, particularly as it becomes more volatile. And for key price levels, in addition to the 200-day moving average, look at the election price gap, still another make or break zone between 58.60 and 5700. And then on the downside, new low breakout at 5504, which unlocks further lower scope into 5400 and 5200. Now, those two levels will be important as part of that bull trap reversal signal akin to 2008, which I'll allude to in a moment. But before I do, the topping sequence, which is originally sourced from Elliott Wave International, as featured by their head, Mr. Robert Prechter. And you can see here this 4-month sequential topping pattern, which began in November and continued up until March. All risk assets remain trapped in a single liquidity bubble. Rally peaks date back to November in equities, crypto, and real estate. Watch for a short-term oversold rally sequence here and now if you're looking for this tradable rally into Q2 2025, but then look for that fast turnaround back to the downside thereafter. And for more information in terms of what's driving this single liquidity bubble, look at the long-term liquidity cycle signal that remains elusive, but more practically review the work of Michael Howell, who's an expert in this field, as part of the Cycle TV interview with our FSC team member, Lars von Thienen, where you can get a little bit more specifics on the liquidity cycle timing. And just to complete the first point of this triple whammy headwind bull trap scenario 2008 where you had this three-stage correction fall rally, which was a head fake to all-time highs, and then the rest of the fall. It's true in terms of pattern, time, but also macro event risk. There are some variations that are playing out here and now, but do look for the potential break below 5,400 and 5,200 as further confirmation, and the long-term trend, a reversal, as an indication of further downside ahead. Now, to follow the second point, rotation fragility. What does all of that ultimately amount to? Concentration risk unwind, systemic risk, which is maybe a new factor to incorporate. And then what we're increasingly seeing is this US exceptional as this peak out and potential rotation into other cross assets and equities as a way of gauging these changes both in the trend and in the cycle. So looking at the concentration risk, this is a chart on FANG, looking at the correction that we've already seen, down 20%. The index level is 10%, but the FANG index is 20%. It's broken the 200-day moving average, but keep in mind not just the technical factors, keep in mind the market cap implications. FANG is worth 1/3 of the market cap of the index. So when it moves, it really does impact. Up move and you're long, happy days, you're making money. Down move, unexpected, high beta effect, which catches most people off center. What's interesting is if we continue to hold below the 200-day moving average, again, it's a make or break long-term trend zone, not just on the index, but here on the tech itself. Keep in mind that there is still a further downside of 10% to go, which would net off a 30% peak to trough drawdown into that 10,000 psychological mark. So watch for the high beta index volatility as if and when this extends, and fragile rotation as part of a new market regime. NVIDIA is definitely worth watching in particular because that's the biggest part of the FANG impact portion. Systemic risk, looking at the sectors, early days indications are showing that. Downturn in tech, also consumer discretionary, although keep in mind some of the stock skew in related stocks like Amazon and Tesla, but also there is further bearish signs seen on financials, healthcare, all suggesting potential systemic event risk in US equities here and now. Could this signal further breakdown, not just in the market, but also a slowdown in the economy? How will US policy likely surprise in the coming weeks and months? So do continue to watch sector rotation and the increasing breakdown and likely systemic risk and what that means for both markets, economy, and policy. And then just to close on this second point, world leadership, US exceptionalism remains strong, but likely overstretched due to a healthy unwind, as you can see here on the first chart by Bank of America versus the rest of the world. Ratio serves only as a reference guide, not a timing indicator. Historical nuances should also be kept in mind, such as valuations, especially when you're going as far back as the 70s, but nonetheless, it shows just how overextended US exceptionalism is in terms of equity market outperformance. In terms of here and now cash flow, you can see that portfolios are, or were, I should say, exiting between December 2024 and March month 2025 just passed. Now that has been mostly cross-asset influenced. So we're seeing a safe haven flow into treasuries and into cash and other vehicles like gold. But in the equity space, it has been Europe and China, particularly China tech specific. You can see there in figure 3, China tech versus US tech, and figure 4, Europe-US rotation. The first chart on China is equity market performance, China versus US, and figure 4 shows the outflow, ETF outflow in terms of real money that is rotating from one to the other. Bearish timing confluence, just to close, timing. This is what we're all about here at the Foundation for Study of Cycles, particularly when there's a confluence of timing indications. Personally, I use a range of variable timing tools, which are diversified, so that way I don't get the same thing, give me the same message, but also when they do give me a confluence, it is a higher probability. So first and foremost, we're going to look at the FSC model, then a recap on the election pattern, and then to close, seasonality. Looking at the FSC model, we can see short-term, long-term, giving divergent perspectives because, of course, we're in a changing market regime post-shakeout. First point to highlight is that the short-term model and the long-term model did confluence and confirm a peak in markets early this year, and specifically March. The long-term cycle based on the 41-month tried and tested cycle popularized by our co-founder Edward Dewey, and the short-term cycle you can see here now gives the real-time picture, which every trader should be watching, for the market bottom, likely oversold rebound, but further risk for a peak and downside resumption in April, and then summer months from July onwards into the second half. So remember those inflection points ahead. Also keep in mind, just here at the bottom right-hand chart, figure 3, showing a natural cycle based on solar activity. Remember, macro systems influence mood and then markets. That peaked out in summer 2024, confirmed in 2025, but bottoms in 2030 in the early part of the next decade. So that shows, early indications of a top here and now with a potential retest in year end. That's something I can revisit later on. But more specifically, the worst is expected not now, but later. So a little bit of positive relief here and now, but do keep in mind, potential need to mitigate worst case scenarios further on into 2020, 30 onwards. And you may have concurred that with other cycle analysis. I do read the comments on our YouTube channel and, of course, follow up with emails that are sent post-session. So do feel free to let me know if that matches any timing models that you are also looking at. And just to recap, the election strategy playbook, 2 patterns: buy the rumor, fade the fact in terms of the election result, and then the inauguration. Remember that the implications are because of profit taking and policy stress testing, particularly within the first 100 days. And here and now, a 2-scenario pathway for either an incumbent or first termer, the difference between the two being confidence. Even though Trump ultimately blends between the two, their sentiment is being exacerbated because of policy uncertainty, as mentioned, because of economic growth concerns, tariff risks, and this ongoing rapid-fire policy announcements, which is creating uncertainty and volatility. So let's see how that plays out. But for now, it's been more bearish than bullish. And historical analogs do give us a roadmap, only probabilistically, and ultimately reality will prove out in the coming weeks and months as things change. And then to close, seasonality on a more short-term, actionable timing framework. March often serves as the battleground for between bulls and bears, akin to Julius Caesar in Roman times, warning to beware of the edicts of March. There is typically a near-term bounce set up here and now and over the next few weeks, so that does chime with the seasonality market rhyme. And this is according to the Almanac Trader. Do look up their work. They are experts in seasonality analysis. The event risk likely weighed in by policy, macro data, or geopolitical tensions. thereafter. Bearish seasonality follows, remember, in June, which is typically the second biggest drawdown month of the year ahead of Q3, September, October, which is well known for the largest sequence of the two in terms of bearish drawdown. So I'll spotlight that again month on month, especially as we approach those key inflection points on seasonality. But for now, buy on the dip or dead cat bounce. My money is looking for a short-term rally, but one that is not sustainable. So you can trade it, but trade it with care. And remember the recap of what we've covered, insights on the implication of the speed of this correction and the likely follow through, the snapshot of market analysis, and the update of the S&P 500 triple whammy risks. And of course, you can watch media engagements, which covers some of this in a few minutes, as well as a recap of this vlog itself. That's it from myself, Ron William, Global Cross-Asset Strategist and FSC Development Director. Feel free to stay in touch. Thank you very much. Welcome feedback and questions via the FSC or through social. Happy trading, and look forward to speaking to you all again next month.